Canadian home price drop risks putting over $34 billion worth of loans underwater. And that is just a tip of the iceberg of what could happen, as we're going to get into with these articles. So it's just kind of crazy. This housing bubble has been on steroids, as we know. So falling Canadian home prices and higher mortgage payments have eaten into the value of borrowers' investments, or speculations, you could say. And a further 20% decline in prices could push 34 billion US of home loans at the country's largest lenders underwater, according to a new report. So over 46 billion Canadian dollars worth of loans could go underwater. Now you're probably thinking, well, Luke, I'm sure the banks have plenty of liquidity. I mean, I'm constantly hearing from my mortgage broker, my realtor, and the politicians and central planners that our banking system is rock solid. Anything could hit the Canadian financial system and we'll just be okay. In fact, having a banking monopoly is great for the country because that means stability. You would be wrong by that, and we'll get into that in a minute. So anyway, homeowners are already feeling the pinch, putting it mildly there, aren't they? With the 6 banks holding more than $2 billion in mortgage balances in a negative equity position, meaning borrowers owe more than their positions are worth after selling costs. Canadian home prices have slipped 17% since their peak in March 2022. And just so you realize, guys, we're coming up on that. Obviously, this year it's going to be 2 years since the prices started declining. And one thing people don't factor in is the decline in their dollars. They don't factor that in at all. Of course, we've had rampant inflation in between. So in real terms, people are losing insane amounts of money. And this is definitely a crash. Cover up, the real estate industry doesn't want to call it a crash. And once again, they're coming on trying to generate hysteria by misleading buyers in the early stages of the spring market. And who knows, we could see another bull trap, or we could see the start of the fear and capitulation. It's really hard to tell when you're in this bubble because, like I've said many times, it's all based on emotion. So Canadian banks often tout the strength of loan-to-value ratios in their domestic mortgage books, noting that borrowers have a lot of equity in their homes to fall back on in troubled times. While that's true for most mortgage holders, the average loan-to-value ratio at the country's 6 biggest banks was 51% at the end of fiscal 2023, according to the KBW report. Some don't have that same cushion. And you've only got to think of all the people who piled into the real estate market in 2021. Those people are really being screwed. And you've only got to think about all those people who are in negative amortization right now. There is a massive amount of negative amortization loans out there. And it's kind of crazy because that number alone is more than $250 billion worth of loans. It's crazy that we got all these risks and nobody really talks about them, but they will cause problems in the future. If home prices drop 10% from where they stand now, the balance of mortgages in a negative equity position could swell to 10 billion Canadian. The less likely scenario of a 20% decline in prices could result in about 3.4% of the 1.36 trillion in total uninsured mortgages and home equity loans at the country's 6 largest banks being put underwater. And notice how they're only talking about uninsured mortgages there. You've got to remember there is a significant amount of insured mortgages that are out there. I mean, if they're saying 1.36 trillion, well, what about the other 700 billion? Because we're well above 2 trillion total now in mortgages. In fact, it's over 2.1 trillion. It's over the entire GDP of the country in Canada. So, you know, a lot of these loans are obviously insured as well, and those are more likely to be underwater. And the thing is, having spoke to somebody who used to actually work at the CMHC, and basically it's not like we think the banks can just get their money back really easily if a buyer starts defaulting. It's actually way more complex than that. And if they don't do certain things within certain time frames, then they won't pay out at all. And that can be by letting the borrower essentially get away without paying, by allowing them not to pay. Like this Canadian mortgage charter that Freeland's touting kind of implies that she wants banks banks to do that. She wants them to just say, hey, don't pay your loan for now, even though you're obviously in distress. We'll just wait, and then hopefully you get better. And we know how that goes with the global financial crisis. So it's kind of insane what is happening. And then you've got this coming out from Oxford Economics, who have been saying about the housing bubble for years, and they are now being proved right now. We're definitely in a housing market crash. Real estate agents, mortgage brokers, once again, they're not going to say that. But just think about it. If prices are down 17%, easily we have lost 20% of our purchasing power since 2022. So, you're talking about a 37% real decline. And I think that is just being low, on the low side. I think inflation has been a lot higher than that, as you probably are aware. So Canada's economy isn't just slowing down, it's already in recession. How often have we been saying that on this channel, guys? We've been saying it constantly, that Canada is in a recession right now. We're heading into a depression, in fact, unfortunately. But I believe that they're just going to continually hold interest rates high. I believe the fact that bond yields have dropped is providing even more cover to hold interest rates higher for longer. Of course, if an economic crisis happens and something really hits the fan badly, then they're probably going to come in straight away and cut interest rates. But if it doesn't, I think we're just going to see these interest rates held up high. And really, it's going to sting a lot of people who were betting on rate cuts by now. In fact, this time last year, people were betting that rates were going to come down at the end of 2023. That didn't happen. We're now in 2024. And even I thought rates would come down, guys. And I was totally wrong on that. And now I'm kind of thinking, well, everybody is saying that rates are going to come down this year. So I'm thinking the likely scenario is probably the opposite of that they don't come down at all and do something that nobody's talking about, which is just staying the same, because people are either on one side of the boat or the other. They're going to raise rates more or they're going to put them down. So interesting. Anyway, Canada is already in recession. Hard landing expected. No shit. The firm is the latest to state Canada is already in a recession. They point to recently reported Q3 GDP, which showed a quarterly decline of 0.3%, minus 1.1% annualized. So the economy contracted 1.1% annualized. Just think about that. That is crazy when you think that they are deflating these growth numbers with the wrong rate of inflation. It's the CPI that they're using. And then think about all the government spending. We went through it last week about how that's more than 50% of GDP essentially now is government spending. So without that, the private sector, the capitalism portion of the economy is not only contracting, it's absolutely collapsing. And this is what the central planners cannot understand, who just focus on these figures and don't even understand how they are even produced. I mean, Freeland is a freaking journalist. Trudeau is a drama teacher. Do you expect them to understand? I mean, a lot of people put these politicians and central planners in high places, but the reality is they're no smarter than you or I are. So it's kind of crazy to look at them, but a lot of people do. They're always pointing to the Bank of Canada, Chrystia Freeland, Justin Trudeau. So anyway, it shows this chart about what the Bank of Canada's expectations are, Oxford Economics, and actually what's happened. So you can see that Q3 GDP was right on track with what Oxford Economics was predicting. They're predicting more contractions throughout into 2024. So this is going to be a hell of a long recession. And think about how labor lags. That's the thing. I've constantly been saying it, but it is so true. When it comes to unemployment, that lags far behind. And people are going to realize that pretty quickly. And we're already seeing the labor market that is completely destabilized right now. It is not what it was like in 2021 and 2022. In 2023, the labor market, the wheels really came off. And again, people just don't notice it. And the figures, again, I just don't trust them. Even the unemployment data, which we will also be going through with the recent report that's come out. And then for some reason, at the end of 2024, they're expecting that growth is suddenly going to start rising out of somewhere. Again, I think that that is an optimistic scenario right right there. I don't think that's going to happen because think about it. I mean, they're probably factoring some type of rate cut that's going to stimulate demand more. And I just don't, I don't see that. That never happens. It didn't even happen in 2020. And then they came out with a massive amount of fiscal government spending and stimulus. That was what propped up the economy. And it didn't even last a year or two, guys. It was gone within a couple of years. And the ramifications of that were high inflation. So anybody who's kind of thinking of a repeat of 2020 is going to be bitterly disappointed, because that will be an even worse scenario, because then we're going to have inflation 2.0. And I think that is very likely, actually. So anyway, comparing this, guys, because they were talking about how much here, $34 billion, right? 46 billion Canadian. Well, if you look at the bad loan provisions and you take a bank like CIBC, for instance, here, the bank's total provisions for credit losses increased to $736 million. And that's Canadian. That's not even $1 billion, guys. We're talking about billions in terms of loans that are going underwater. And the banks have got millions. And I know it's hundreds of millions. And I know these are big numbers. And when you see them in a story on the Financial Post, you think, wow, they're increasing their provisions. These banks, they're rock solid. They're doing the right thing. They're preparing for something really gnarly. But the reality is that when it comes down to it, they're just expecting that everybody's going to pay their mortgage and everything's going to be fine. And they're just expecting a repeat of probably 2008 that will just be fine. And for some miraculous reason, Canadians aren't like the rest of the world. This bubble is different. This time is different. God, it's dangerous when people say that. And they're thinking that Canadians are just going to pay their mortgage. You know, they're just not going to default. I mean, it's all about the debt. It's all about the debt bubble, in my opinion. And when you look at what's happened to GDP per capita, guys, that is the real thing that is crazy. You know, Canada is the only G7 country now with GDP per capita that is below 2019 levels. So the economy is clearly stagnating, and this isn't even a great number to look at, because again, you're using the phony CPI and inflation numbers when you're looking at data like this. And if you want to know who actually owns CIBC, guys, you've got to look at something like this. So thanks to Charlotte for sending me this. I think it's quite a brilliant article. But retail investors account for 54% of CIBC's ownership, while institutions account for 46%. So let me put that into context for you, because you're probably thinking, well, what about other banks? Let's take Bank of America, for instance. So you've got 37.75%, which is public companies and individual investors. So it's even less. It's probably less than 35%. Meanwhile, at CIBC, retail investors own more than 50%. They own more than half of the bank. So when you're thinking about who owns these banks, it's mostly going to be retail investors that are caught holding the bag on this one. And doesn't that kind of show you the disconnect there between what institutions are thinking and what retail investors are thinking? And doesn't that kind of show you also who's propping up their stock price? It's unbelievable. And people are probably thinking these are solid dividends. They're not going to cut dividends. Everything's going to be fine. These banks are solid, blah, 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 blah. I mean, I think some people believe that the monopoly is actually a good thing for stability of the banking system. I think that is the polar opposite when you really think about it, because not only are these banks holding dodgy mortgages, they're holding dodgy commercial real estate loans, dodgy loans in China, all these other things like BMO and Scotiabank, for instance. So it's kind of crazy what is going on right now. We are in a recession, 150%, and we're heading into a depression. So prepare right now, get a plan together. That is actionable advice for anybody watching this video. Do you have a plan? If your business starts losing massive amounts of income or you lose your job, do you have a plan in place? If you don't, get one. Now is the time to make a plan. If you've enjoyed this video and you're looking for a VPN to get around all the censorship rules in Canada which block you seeing certain content, then go to expressvpn.com/market mania. That's the VPN provider that I use, and it's the fastest VPN. And if you're looking for a video more about the banking system, check out this video from the other week. And if you're looking for a playlist where you can binge watch a bunch of videos, check out that playlist there. I will see you in the next video, guys. Take care. Bye-bye.